Right now, we're going to find out what is going on in the stock market. With us today is Steve Vanelli, former portfolio manager. He managed over $500 million in assets. I get the funny feeling he knows what's going on. Welcome, Mr. Vanelli.
Thank you, Carlos.
So, that's the question. Donald Trump said it earlier. What the hell's going on?
Well, it's probably led by oil. Oil and the Fed. Oil has been weak, and it has dragged down an awful lot of commodities with it. It will. The prices on oil are, most people expect to continue to go lower, and this is probably going to cause some financial turmoil in the petroleum industry. And so I think there's a fear factor there. Secondly, the Fed. If you go back a while, the Fed had an opportunity in August to say something and get things going in the right direction. And the head of the Fed just missed that opportunity completely. And today, the head of the Fed out of San Francisco, a guy named Bill Dudley, didn't even mention the volatility of the market. It would just totally not there. And so that was those were factors. And then there was industrial production that came out, numbers on industrial production for December, and they were a disappointment. You put all that together, and then you started selling, and it just feeds on itself. Let's not forget this market's about 75% institutional, and an awful lot of hedge funds, and they just go crazy and just start selling today. And volume was strong. You had about, I don't know, the final figures are probably not ready yet, but about 90% of your stocks were over today.
Wow, 90%.
That's it. It was somewhere around 90%.
Let me ask you a question about that oil, because I know a little bit about economics. Everything works almost like a spider web. What I mean by that is, when oil prices start dropping, that just does not affect only the energy sectors. It starts affecting a lot of other areas, and it means a lot of things, doesn't it?
Absolutely. And, just because the price of gasoline goes down, for example, that doesn't mean somebody's going to drive a lot more. No, they're not. Your demand factor it'll probably improve a little bit, but the supply is the issue. Oil companies have been very successful in developing production, be it oil shale or around the world production. And so you have an excess supply of oil, and it's going to take quite a while to work it off. And you're probably going to see lower oil prices.
And do you think China is a big influence as well in this market?
I think it's an influence. I think you use the word big influence. I don't think it's a big influence. I think it is an influence. More from the fact of their economy is slowing down. It was growing for a while at right around 7%. And some of the revised estimates are as low as a GDP growth rate of 2 to 3%. That will have an impact on the U.S. economy in terms of what we sell to them. But will it be a big? In fact, I don't think so.
Now, we had a fascinating conversation before the show. We were talking about what the market is doing, but you made a very interesting statement or a question. You said, but what is the market saying? So I guess you're the market muse here. So what is the market saying?
Well, I think that's the point of the whole thing. I think there's two issues here. The market just doesn't act randomly. There's a reason for what it does, and it may not be very clear at the moment. But I think the lack of enthusiasm from the standpoint of the Fed is a factor. The price of oil is a factor. And the outlook for earnings. We had earnings come out. For example, we'll take last night, Intel comes out. Their earnings per share were pretty good, but their revenue was a touch light. And that's probably going to be with us during this whole earnings season. And let's not forget, you're in the middle of, or you're starting your earnings season right now. And
Oh, wow.
even though we have a 3-day holiday, next week will be real important in terms of the earnings and how they turn out.
So the market could see a lot more volatility in the upcoming weeks, it sounds like.
It could. And then the other factor is what we call the technical picture. In other words, the charts.
Oh, yes.
And
We have it up right now.
you have it right up there?
Yeah, we have the 3-year S&P for you.
You're at a very dangerous spot here. I mean, if we break through this, which we could very easily break through, and I wouldn't even want to venture a guess as to how low it could go. But this is what I would call an ugly chart.
Now, what do you see? Before we go on, let me make sure we clarify something. When you're saying breaking through, there's a little bottom, right? There's one of the low lows, and I think the number in the S&P is like 1850 or something. I can't remember what the low is. It's the lowest low of the last 52 weeks, correct?
Correct.
And if it breaks that, then you're going towards the next low, really low. And that's where you're saying we can't even see the bottom on that.
Well, no, you can't, because there's no support going back. I don't care how long you want to go back. You're not going to find much support. It's going to be a question of valuation, price-earnings ratios. How low will the price-earnings ratio go? My personal view is it probably won't go much lower because you don't have much inflation. Inflation, if we had, let's say, 3% inflation, then you could take the PE ratio and discount more. But we don't. And so we don't have that level of inflation. And so the PE ratio to say around 15 and a half, 16 times is probably fairly reasonable. Thus the lower level on the market is probably not that far away.
Interesting. And that's something people don't realize, too. Is the market really that connected to the economy itself? I mean, are we seeing like a harbinger here of things to come for the economy?
The market is about 75% institutional. And you have thousands of hedge funds. And you've had some significant liberalization of trading world. And these guys can go crazy and short stock and do all sorts of alternative strategies. And that is a problem, but there's nothing anybody can really do about it. The amount of trading that they'll do is immense. I don't know what the final volume count was today, but it will be significant. And the advancing issues might be 10% of what's traded.
And that's interesting, because I know we've talked about before, and we've got a couple more minutes left, and I don't want to delve into this too deeply, but I do want to get a brief summary from you. The economy is also struggling because of the aging demographics, isn't it?
Yeah, agreed. The baby boomers, like myself, are all getting older, and a lot of them are. Especially you take discretionary expenditures of the top 30%, 35% of households in terms of wealth really accounts for an awful lot of discretionary spending. And these people can get frightened real fast. And that is probably what's going on, is they get scared and they'll back away from the markets.
And consumer spending is 70% of the GDP.
That's correct, yes. And, you had a great year in automobiles last year. The forecast that most people are putting out is for another good year of automobile sales. But you got to begin to question it, especially if you have another 2 or 3 weeks of a soft market. I'm not saying much of a repeat of today, but if you just have a soft market, then people will get concerned and they'll restrict their spending.
Absolutely. It is. It's an amazing time right now. I've never seen it. I think we talked about it before. It's been almost 80, what is it, 80, 90 years since we've ever had a start like this?
A start like this, you mean from the first of the year?
Yes, yes.
I think after today, I think this is the worst start ever.
The worst start ever. Woo!
Well, what have we had? One up day this year? I believe that's correct. And the rest has just been more and more pounding. Hey, you dropped pretty close to 8% or so since the first of the year.
8%.
8?
That's halfway through January, already down 8%.
Yeah, that's roughly the figure.
And last year, whew.
Yeah, I mean, we started the year at 2143, and we closed today at about 1880. So that's about 7 or 8%. And that's ugly. And you know what turns the market around? I don't know, but in time it will. Do you go out and buy stocks now? Well, I mean, that's like the old thing of catching the falling knife. Depending on, I'm 72 years old. I wouldn't be out buying. I'd wait and let things settle out. And they will, but it'll take time.
I get the funny feeling the Fed's scratching their head. Obama's not too happy. It's going to be an interesting year politically.
Very, very. And it's going to be some very interesting commentary from presidential or all sorts of candidates regarding the action of the market.
I won't mention any names, but there is a particular candidate with a lot of business acumen that could be benefiting from this.
Yes, he could. But I don't think it'd be too wise to be saying a whole lot. Because you don't want to try to guess the market. And I think you might do yourself a disservice as a candidate if you start talking a lot about the market.
Absolutely. We saw that with John McCain in 2008 when he said the market was healthy and strong, like Herbert Hoover did in the 1929. Yes. Stephen Vanelli, thank you so much for our weekly update.
Okay, thank you.
We truly appreciate it. Stephen Vanelli, former portfolio manager, managed over $500 million in assets, giving us a look inside the markets this week.